Go ahead and get started. And as people join, they will come on in. So, hello, everyone, and welcome. Thank you so much for joining us today. As people are trickling into the waiting room, let's do a quick sound and tech check. If you can hear my voice and see our slide deck on the screen, please drop a quick yes in the chat box, or you can let us know where you're tuning in from, because I know we've got places all over, I'm sure. Oh, we've got some DC. I love it. I know we've got a Virginia in here as well. Oh, Arizona. Hello. Cleveland. Hello. Liz, I hope you're okay with all the wildfire smoke. I've heard it's been really bad in Ohio. Oh, California. Good morning, California. Oh, good, Liz. I'm glad it's better now. So before we officially dive in, there's going to be a couple quick housekeeping items. First, yes, we are recording. I know that everybody had that question. Um, and you will get a copy of the recording and some cheat sheets sent to your inbox tomorrow morning. Second, please feel free to drop your questions in the chat box at any point during the session. I am manning that. I will have plenty of time saved at the end to get to them if we don't have time during our session to do them. And I am so incredibly excited to introduce our speakers today. So we have Jonathan Morris, and he is the CEO of the Consonance Group, or TCG as we call it. Jonathan has over 20 years of experience in helping nonprofit leaders make sense of their numbers so they can sleep better at night and focus on their true mission. And then we are incredibly privileged to have our co-presenter today, Rachel Zutsky and Zutzi. I knew I was going to say it wrong. Sorry, Rachel. And Rachel is a CPA and audit senior manager at Sidney Cone. She specializes in helping nonprofits navigate complex reporting, compliance, and audit readiness. So, Jonathan and Rachel, welcome.
Thank you, Mackenzie, and welcome to everyone joining us. Rachel, great to do this with you. I want to start today by asking everyone in the audience to take a deep breath. If you logged onto the webinar feeling a sense of dread, if looking at financial statements makes you feel like you're about to take a high school algebra test you didn't study for, you're in the right place and you're not alone. Most nonprofit leaders I know started their organizations or took their executive roles because they're passionate about a cause, not because you were dying to sit with a balance sheet on Friday afternoon. Here's the secret we're going to unpack today. Financial reports are not math tests. They're storybooks. They're just written in numbers instead of words. Once you learn how to read the vocabulary, the reports stop being a compliance chore and start being a powerful strategic tool that you have to steer your ship. Rachel, from where you sit as an auditor, I imagine you see a lot of organizations that are terrified of their own financial stories.
I sure do, Jonathan. And thank you, everyone, again, for being here. And just one clarification, I'm with Snyder Cone, just so everyone, that's okay. Just want to clarify that, but that's fair. So yes, as an auditor, people are usually very anxious when we come in. They think that auditors are looking to find errors with their accounting and give them all sorts of points. But the truth is, we really want the books to be clean and have a really good success story being spoken in those financials. And the biggest gap that I see is that many nonprofit executives and board members aren't comfortable preparing and talking about their financial statements. They look at it sort of as a foreign language that they hope they don't have to speak. And they tend to wait until the annual audit or when the 990 is ready to be filed to really start looking and translating those books. But by then, like the year is almost over and you can't change the ending of a movie once the credits are rolling. That's why Jonathan's side of the equation, daily accurate managerial accounting is so critical. When you understand your numbers month to month, you're not preparing for people like me. You're actually learning how to steer your organization and being able to explain your financials clearly.
I love the analogy of the movie credits, Rachel. And to set the stage for our deep dive today, let's look at one of the biggest traps nonprofit leaders fall into. We call it bank balance management. It's a habit we carry over from our personal lives. If there's money in the checking account, we can buy groceries. But in the nonprofit world, that logic can be a little dangerous. For example, you could have $500,000 sitting in the bank account, which feels amazing, but 450,000 of that is restricted grant money designated for a program that doesn't start until next fiscal year. And then you have $60,000 in operating expenses and payroll coming up short term. You're actually in a cash crisis. You just don't see it because you're only looking at the bank balance instead of how your reports talk to each other.
Yeah, and from an audit perspective, this is really where we see some red flags. When the board or the executive director is only looking at the bank account, they may miss those legal restrictions tied to those dollars. So under GAAP, unfortunately, a dollar is not always a dollar. We have to separate those dollars into distinct buckets based on donor intent. So if your bookkeeping team isn't tracking your cash designated for specific purposes versus unrestricted cash in real time, your financial statements are essentially lying to you. They're presenting that there is stability when you might actually be running out of general operating cash. And so our goal here today is to bridge that gap. We're going to look at the three core reports, the P&L or the statement of activities in nonprofit speak, the balance sheet or statement of financial position, and the budget versus actual. And we're not going to look at them as isolated sheets of paper, but as a connected group. So, Jonathan, let's start with the heartbeat of the day-to-day operations, the profit and loss statement.
All right. So here we have the profit and loss statement, or as Rachel said, the statement of activity. It's two names for the same thing. In plain English, the P&L, profit and loss, tells the story of your operational heartbeat over a specific period, whether it's the last 30 days, an entire fiscal year, the fiscal year through the end of the prior month. It answers one fundamental question. Did we bring in more than we spent over this period? But here's where nonprofits can fall into a little bit of a trap. They open the P&L and immediately you look at the bottom of the page. You look at the net income, whether it's positive, a surplus, or a negative deficit, and you celebrate or panic. Don't start at the bottom. What we really want to look at on the P&L is actually near the top. We want to distinguish between unrestricted operating revenue and compare that to total operating expenses.
Mm-hmm. And that's a big point here. And it all boils down to GAAP, which is generally accepted accounting principles. There are rules that many boards don't understand, and actually, quite frankly, most people don't understand. And it's all about revenue recognition. So under GAAP, if you win a $150,000 multi-year restricted grant today, like if they gave it to you July 23rd, the rules say that you have to record that entire 150,000 as revenue right now. So on your P&L, you'll show this huge $100,000 surplus at the end of the year because that revenue is all running through the current year. But typically that money is legally locked up for programmatic use for future years. So if your day-to-day general operations are costing you about $50,000 more than you're bringing in of unrestricted funds, you're running an operational deficit. So the bottom line that Jonathan's looking at here right now is kind of hiding a crisis because the GAAP rules are forcing you to show all of that restricted revenue up front.
Exactly. So here, let's look at a real world example of how it plays out. Well, imagine a hypothetical youth mentoring nonprofit called Bright Futures. They have an operating budget of 500,000. They open up the P&L. It shows they brought in 550,000 in revenue and spent 480 in expenses. On paper, a $70,000 surplus. The board's happy. Executive director's breathing easy. But when we look closer at the columns, here we've made a distinction between unrestricted and restricted money. We start to see the truth. 450,000 of revenue came from a restricted government contract that can only be spent on program mentoring staff salaries and direct materials. Meanwhile, their unrestricted revenue from individual donors, events, general public support was only 100,000. Their administrative overhead, rent, insurance, payroll taxes cost 130,000 because they didn't separate the restricted and unrestricted columns. They didn't realize that general operating is in the red by $30,000. They have 70,000 of cash they can't legally spend all on general administrative, and they're about to come up short at payroll time. This is why we have to stop looking at revenue as one giant bucket of money. A healthy nonprofit P&L must tell you not just how much money you have, but what kind of money you have.
Mm-hmm. So when leaders hear this, they sometimes panic and they think, Oh no, we have to raise an extra 30,000 of unrestricted donations, today. But what I can tell you is that you don't necessarily have to raise more money. You might just need to learn how to compliantly recover your overhead costs with the existing grants that you have.
Yeah, this is really where the magic of strategic nonprofit accounting happens. Your restricted grants should be helping pay for administrative costs, but you have to build the bridge. And also, we need to note different funders have different rules for this. So we need to check your actual grant agreements here to make sure that you're in compliance. But we have two kind of general methods for recovering operating costs. One is direct cost allocation. So, for example, if your executive director spends 20% of their time overseeing that mentoring program, 20% of their salary and payroll taxes and benefits should be charged directly against that restricted grant. If your mentoring program uses 2 rooms in your office space, a proportional percentage of rent, utilities, and occupancy costs can be allocated directly to the grant. The other method is using an indirect cost rate. Right now, the federal de minimis rate is 15%. So under federal and state funding rules, you're legally entitled to recover indirect costs.
What time do you think you're coming in tomorrow? Because somebody's asking the Daniel.
Sorry, got that. I'll back up. So under federal and state funding rules, you're legally entitled to recover indirect costs. Even if you don't have a federally negotiated indirect cost rate, you can almost always write that 15% de minimis rate into the grant budget. It means 15% of that grant can go straight towards covering general administrative overhead. In the example on the slide, we're using 10%, which was the old rate. So 45,000 of that $450,000 grant could go against the general operating column. So look what happens when we do that right. Instead of letting 130,000 in overhead sitting entirely on the unrestricted side, they work with their finance team to compliantly allocate 35,000 of shared administrative and facility costs to the grant. And suddenly their unrestricted deficit drops from 30,000 in the red to actually a manageable 5,000 surplus. They didn't have to raise any extra money. They just learned how to distribute their costs strategically and compliantly.
Mm-hmm. And from an audit perspective, I do want to emphasize compliantly. So as auditors, we do look at what you're allocating to each grant of overhead, but we can't accept like just a ballpark estimate or a finger in the wind estimate. You can't just guess at the end of the year and charge a specific percentage. So you must have a documented systematic cost allocation methodology. And so this means either tracking actual time that your employees spend via timesheets on each program, or a documented methodology of the estimate, how you're estimating the time that your folks are working on specific projects. Another way is to allocate rent based on the actual square footage utilized by the program, if that's something that's easily estimable. And when you have a clear written allocation policy, auditors can test it, verify it, and discuss its reasonability. And so that your methodology should always be reviewed periodically and revised based on the activities undertaken by the organization, because those can change over time. And this also keeps you fully compliant with federal uniform guidelines, which we'll talk about a little bit later, and then any audits that you have to undergo for different funders or because states have compliance rules, but also while ensuring that your unrestricted cash is preserved.
I love that, Rachel. It turns compliance from a set of restrictive rules into a strategic system that protects the organization. For leaders tuning in who want to go back to their desks today and make sure they're utilizing these cost recovery strategies, here are 3 questions you can ask your bookkeeper or your finance team. One is, are we compliantly allocating a proportional percentage of administrative, executive, and facility overhead directly to restricted program budgets? Question 2, what percentage of our year-to-date revenue is unrestricted operational runway versus restricted grant funding? And question 3, do we have restricted grant expenses that we've paid for but haven't officially released or matched on the P&L yet? If your bookkeeping team isn't doing monthly releases of restricted assets, your P&L is going to look like a roller coaster because you might show huge surpluses one month and massive deficits the next. It can really mask actual operational trends.
Mm-hmm. And then, so that's great. And so we're going to transition. As we transition, remember, the P&L only tells you the story of the year, but it only tells half the story. So to understand if your organization is truly stable, we'll have to look at the Polaroid snapshot of your overall financial health, the balance sheet. But I do think there were some questions maybe coming in that we might want to, do we want to get to those before we move on?
Yeah, I think it's a good time before we move on just to ask those questions. So we're looking at the federal indirect cost rate. That's only for the federal grants, right? Or will that take place with local ones too?
Whatever indirect cost rate you use, you have to apply consistently across the board. So
Okay.
you can't. So often, if you receive a federal award, you're going to use that rate for all of your different programs.
Great.
Rachel, do you have an additional
Yeah,
question?
yeah. So what Jonathan was talking about, the de minimis rate is if you don't have, like, if you don't have another method, like when you're getting a federal grant, that's like you can use that rate in place of another rate that you would come up with on your own. But for other tracking purposes, for other grants, it's really based on those, like either timesheets or an estimate of time that folks are spending on the specific projects or programs.
Okay. And then have either of you or both of you noticed a trend um, with the allowing more or less in that overhead percentage allocation, or maybe a movement towards more unrestricted funds?
Rachel, what do you think?
Yeah. So, I mean, I think so for, for our clients and clients that we're seeing, I mean, there definitely is the smaller organizations are really trying to go towards those unrestricted grants for just general operating. But again, if they do have restricted grants, they do try to, I would say in smaller organizations, it's probably more than 50% overhead because if it's a small organization, likely those folks are working on a lot of programmatic things and not just general and operating.
All right. And then if we can go back one slide, um, I think I'm not sure if you're Kristen, if you're talking about the slide that we're currently on, we haven't gotten there yet. So this
Well,
slide is what we're kind of still talking about. This slide we haven't gotten to yet.
which, but to your point, yes, 15% is the current rate, 10% is the old rate, and some
All right,
of the slides did use a 10% rate. But
perfect.
you're absolutely right. The new rate is 15. Okay, shall we move on to balance sheet then? The balance sheet is your single Polaroid snapshot. If we freeze frame your organization's financial life at exactly midnight on the last day of the month, what do you own? What do you owe? And what's your net worth? Now, if you only have 2 minutes to look at this sheet, first thing people search for is cash. They want to know how many months of runway do we have before we run out of money. You'll often hear financial advisors tell you you can only calculate your runway using unrestricted cash, but there's a real world nuance here that sometimes gets missed. If you're doing the bookkeeping correctly and releasing restricted grant funds every month to match your programmatic spending as it happens, then total cash divided by average monthly burn rate is actually a pretty healthy way to estimate your runway. That program restricted cash is actively keeping the lights on right now. The danger isn't program cash you're spending today. The danger is what I call time capsule cash. This is cash sitting in your bank account that's legally restricted for future years or restricted for a capital campaign, to buy a building, or locked in a permanent endowment. If you have 300,000 in the bank, but 200,000 of this is in time capsule cash, you don't have a comfortable runway. You have 100,000 of usable cash and a potential timing crisis waiting to happen.
Mm-hmm. And that distinction of time capsule cash is important because that's a lot of what we look for when we audit a nonprofit. So one of our jobs in the audit is to assess the organization's going concern, which is just a fancy term for do you have enough cash, usable cash to survive the next 12 months. To show this clearly to your board, your donors, and your auditors, GAAP requires a specific disclosure in your audited financial statements called the liquidity footnote. And it's at the bottom of the slide that Jonathan is showing. So when we present to boards, we always highlight this footnote because it basically shows what cash you have available to meet general expenditures within 1 year. So it takes your liquid financial assets, which are typically your cash, your current accounts receivable, and investments if you have any, and then it backs out any items that are restricted for future programs, like Jonathan showing here, the negative 200,000, or any grant receipts or receivables that you are not expecting to receive until the year after the balance sheet date. So here, this is showing that it is $100,000 to meet general expenditures within 1 year. So that's the important number here. So basically, this is the bottom line of the footnote. And so this is basically what you would use to analyze how much you have to spend on general expenditures.
Exactly. That bottom number in Rachel's footnote is what we're trying to manage in real time every month. So if you're only looking at the total checking balance, you might think you have plenty of money to launch something new, but we would be unaware that a lot of that current cash is actually locked in a time capsule.
Doesn't help when I start talking and I'm on mute.
Yeah.
So that leads beautifully into our next topic, which comes from a massive pain point that we hear rapidly growing in nonprofits. They'll say, our P&L shows that we're growing fast and we just won 3 new government grants. We should be celebrating, but our bank account is completely empty and I'm losing sleep over payroll. How is it possible to look so successful on the P&L but be drowning on the balance sheet?
This is a common problem, fast growth cash flow crunch. It's a painful and too common trap in the nonprofit sector. A lot of government contracts or grants are cost reimbursable. So you have to spend money first, hire staff, deliver services, buy materials, and then submit an invoice and get reimbursed. So if you win a $300,000 government grant, it looks like beautiful revenue on your P&L. But on the balance sheet, your accounts receivable line, the line that shows the money people owe you, that balloons up $100,000 when your actual cash drops to zero. You're profitable on paper, but you're cash poor in reality. So if you don't have a working capital line of credit or a robust cushion of truly usable cash, then the grants that were supposed to scale your organization up can actually run you out of business.
Mm-hmm. And this is one of the things that we look at closely during an audit. We're looking closely at what's in those accounts receivable, and in particular, the accounts receivable aging report. So if you have 150,000 in receivables, but $90,000 is over 90 days past due, we have to take a look at that. We have to see if you're really expecting to receive it, and then also whether there should be an allowance for doubtful accounts, which means you have to adjust that accounts receivable downward with something we call an allowance. And so that the money might not arrive in time to help, or you may have to write it off completely if you're not expecting to receive it. So if you look at just the P&L and they see that the revenue is 300,000 and then they want to launch some new issues, new initiatives, you have to realize that your cash flow is sometimes tied up in waiting on receipts from those grants. So you have to look at both reports together to see the full picture.
Exactly, Rachel. And it's all about the timing of when the cash actually moves. For directors and board members listening who want to make sure they aren't falling into these traps, here's 3 questions you can ask your finance team at your next meeting. If we divide total cash by average monthly burn rate, does that give us true operational runway, or is that number inflated by time capsule cash that's meant for future years? Question 2, do we have an aging report for accounts receivable? And are there any outstanding grant billings or donor pledges that are more than 60 days past due? And number 3, are we keeping restricted grant cash in separately tracked accounts or classes in QuickBooks so that we aren't accidentally borrowing from tomorrow's program to pay today's rent? If your finance team can answer those questions clearly, you won't be surprised by the empty bank account again.
Yeah, and that's such an outstanding diagnostic checklist. You guys will be getting that in your email tomorrow, those questions. So don't worry if you didn't write them down fast enough. That was really fast. It completely takes the fear out of reading that balance sheet. So now that we've looked at the movie of our year with the P&L and we've taken our Polaroid snapshot of our health with the balance sheet, let's look at the report that ties them both together and acts as our dashboard for everyday steering, which is the budget versus actual. So, Jonathan, can you tie this back to the storybook metaphors?
um, Maybe we'll see if I tie over the metaphors. The BVA, the budget versus actual, is where we compare the original written script to the actual footage that we're filming in real time. So your annual budget is that script. It's the story you planned to tell this year. But as any director will tell you, what's written on the page rarely matches the set on day one once you start filming. So the BVA is your tool to monitor how your plans line up against what's really happening. It's how you make smart strategic edits while production is underway. One issue we hear from executive directors frequently is that they're terrified of presenting this budget to the board because they'll say, I can't present a budget to the board that shows a projected deficit. But the only reason we have a deficit on paper is because we're spending grant money we carried forward from last year. Why can't we just list that carry forward cash as current year revenue so the budget looks balanced? Rachel, how do you answer that one from the auditor's chair?
Well, we see this panic a lot in, board meetings. We get this question a lot as auditors when we're presenting the financials to the board. And so I think the board's confusion here is completely understandable because they're trying to apply corporate logic to nonprofit reality. And so, like in the for-profit world, there's a matching principle, revenue and expenses align in the same period. But for nonprofits, it doesn't always work that way. So we can't arbitrarily slide that restricted revenue into year two just to make the budget look better on paper. Okay, under the GAAP rules, the timing rules, as we explained in previous slides, if Bright Futures won that $150,000 multi-year grant in year one, they had to record it all in revenue in year one. So in year one, like we discussed, showing a really nice surplus, but now in year two rolls around and now they have to spend the cash on to actually run that program. So in year two is when the expenses are coming out. So it looks like you're running a deficit in year two because you were legally required to recognize that revenue last year. So on paper, it's showing now a projected deficit. And so the board opens that budget, sees the deficit, is not happy. They think the organization is overspending, when in reality, they're just executing the exact program that they were hired to. And so with the cash, it's already sitting safely in the bank account.
Exactly. So year one looked like artificially like a triumph, and year two looks like a failure, even though the cash flow is perfectly stable. The key here for executive directors to realize is you can't use a compliance-based GAAP financial statement to run a strategic board meeting. You have to build a bridge between compliance rules and managerial reality. So if you only show your board the standard GAAP budget, you're kind of begging for a stressful meeting. You have to give them a translation tool. At Consonance Group, when we build board financial packages for clients, we solve this by introducing this below the line managerial adjustment. So on the BVA slide we have up right now, you can see how we do it. We show the GAAP operating budget with its scary deficit at the bottom, but then we add a separate section below that line. Here it's labeled funding from prior year restricted net assets. Pull that carry forward cash up from the balance sheet and add it back here. And suddenly that scary deficit goes back down to a perfect zero. It's a simple, highly visual adjustment that instantly lowers the temperature in the room. It shows the board, yes, we're technically running a GAAP deficit on paper, but we're already fully funded in reality. Rachel, from your side as an auditor, does presenting these non-GAAP supplementary schedules cause any compliance issues for you?
No, not at all. And this is one of the things that we are asked frequently as well, is when we go into audit, we are not auditing your internal financial statements that you're presenting to your board each month. We look at them to see, what type of reporting package you're giving to the board and just, looking at that as a guideline. But they're not subject to the same audit standards. So we do like to see supplementary schedules and that the supplementary information here is highlighted because we will be asking for some of those supplementary schedules. We need to see how you're spending down prior year restricted net assets. So those are very good to have on a month-to-month basis because then when we're going in for the audit, we are just looking at when Jonathan's showing funding carried over from prior years, the 150, we want to see how you're spending that in the current year. So we have no issues with supplementary schedules that you're giving to your board or non-GAAP, internal financial statements. Those are just to inform the board and make sure that management and the board are aware of the financial state of the organization. And then again, the fact that these things are tracked month to month or these reports are given month to month really makes the audit testing incredibly easy and because it's already laid out for us. And it validates to your board and your auditors that you're steering the organization responsibly and you're using those donor funds responsibly and for their purpose, regardless of how the strict gap timing rules make the surface level numbers look.
That's such an elegant, simple fix. It really turns that potential board crisis into a moment of clear strategic reporting. So, can we talk about the BVA for actual steering? Like when a leader is looking at their monthly budget versus actual, and they're going to see deviations from their written script, and nothing ever goes exactly to plan. We know this. How do they know when a variance is just a minor script ad lib and when it's a major plot hole that requires a total rewrite?
This is all about understanding the difference between a timing variance and a structural variance. A timing variance is that temporary ad lib. For example, if your budget versus annual, if your if your budget, if you, I'm sorry, if you budget your annual business insurance premium to be spread out over 12 months, the insurance company bills you the full amount in January. When you look at the report in January, you're going to have a big unfavorable variance. But that's not a crisis. It's just a timing issue. By the end of the year, that variance will naturally melt away. A structural variance, on the other hand, is a fundamental shift in your financial reality. If your utility bills are 20% higher than budgeted in January, February, and March, that's not a timing fluke, that's a structural trend. And if you ignore structural variances, a small monthly leak can quietly turn into a gaping hole by the end of the fiscal year.
And from, compliance and grant perspective, tracking these variances month to month is crucial here because either the government grants or even other, private foundation grants, other donor funded grants, a lot of them times they have compliance rules regarding budget line item variances. So even during an application process for some regular grants, you are required to prepare a budget. And sometimes when you receive the grant, there are line item variances that you can only go over 10% here or 5% here. So tracking that month to month is crucial because you don't want to get to the end of the year and figure out that you overspent by 20%, which means then if they're only allowing a 10% variance, that you will then have to eat the other 10% and use unrestricted funds to cover that. So it's really crucial that you're looking at these things month to month so you can be aware of any variances and catch them that month as opposed to waiting till the end of the year. And so that's why it's really important to have outsourced bookkeeping team closely monitors this, closes your books accurately each month, and provides a budget versus actual by mid-month, the future month, so that you're getting the warning system and you're getting up to speed on when you might need to ask for an amendment before you violate the terms of the award.
Okay,
Exactly.
that might have answered Jennifer's question about example of needing an example of timing variances, but is there another example you could give maybe to clarify timing variances in general?
Yeah, I think well, the insurance is one, but really any expense that you just expect to happen in one month and it happens at a different month or is distributed over less time, you're going to see a big variance at the period that thing happened where the timing was off, but you won't, but it will work itself out. Um, uh, I think
I would give an example, like if you don't mind, Jonathan, if I could
please.
jump in with an example. I think a good timing variance would say, because typically, say you're expecting to pay, say you've hired someone to fix, I don't know, your fix your HVAC system, just for instance, it's a good, right? And you have contracted them, you put it in the budget, you thought it would happen in June. It doesn't happen until August. So that expense, when you're looking at year to date, because typically you straight line the budget, right? And then so you'll see that, oh, it looks like we've underspent in June, but really that cost is not going to come in until August. Is that helpful?
Yes, got it. Thank you.
You're welcome.
Oh,
Go
yeah.
ahead, Jonathan.
Okay, good. No, that's great. Then I think we can look at the big picture now. Let's move on from budget versus actuals, and see how things really tie together and how things move in real life.
Okay, so as the nonprofit grows, the complexity of managing these three tools increases, right? So, Jonathan, you started out decades ago as a freelance bookkeeper, and now TCG runs full-scale outsourced finance departments for organizations across the country. So, how does or how would an executive director know when they've officially outgrown doing this in-house or relying on a volunteer board member to run this?
Mm. It's a question of operational bandwidth and peace of mind. In the early stages, what we've labeled here as a garage stage, an executive director usually does the books themselves, or a board treasurer does it, sometimes another admin staff. At that point, things are often done in just a simple manner, mostly on a cash basis, hopefully recognizing revenue correctly, and transaction volume is pretty low. But as you start winning restricted grants, if you have hiring staff in different states, or generally as the annual budget gets past that $500,000 mark, that DIY accounting starts to become a liability. You'll know you've hit the limit when you experience what we call the Sunday night discrepancy, when the executive director is losing sleep on a weekend because you're trying to resolve some kind of variance in QuickBooks, instead of focusing on more important things like donor strategy or supporting your staff, or if it's Sunday night, maybe not even thinking about work at all. That's a trigger that it's time to hire a professional bookkeeping team, because you need someone to run the daily machinery so you can get out of the weeds. As you start to scale past $1 million, between 1.5 and 2 million, another milestone emerges, that you don't just need clean books, you need some forward-looking financial strategy, cash flow forecasting, multi-year grant modeling, and board-ready dashboards. You certainly do not need a full-time CFO, which would cost somewhere 150 to 200K. But you do need a fractional CFO, a high-level partner who can step in for a few hours a month to translate the numbers into strategic decisions.
Yeah, and we have got a question. When do small organizations typically outgrow QuickBooks or the equivalent of that, or need a more robust tool than QuickBooks?
Surprisingly, you can make do with QuickBooks for a good long time. We have clients that are approaching 5 million budgets. With one client that's over that they're still in QuickBooks. It's fine. Like, as long as it's configured correctly, we can make that work. There are a couple of scenarios where you may need something different. One is if there's a particularly large portfolio of various restricted funds. That's when the leap to Sage Intact sometimes happens. Another scenario is if you have related entities, if you have a bunch of related companies, C3, C4, things like that, where you need to do consolidated reporting and separate reporting. QuickBooks is not the best tool for that.
Mm-hmm. Yeah, my answer would be similar. The clients we see that use the next level are typically ones that need to consolidate multiple entities, because QuickBooks doesn't really do a good job of that, or they have really complicated grants that they have to keep track of in different modules.
All right. Excuse me, I'm so sorry. Everything
That's
is
okay.
blooming again over here. So that makes total sense from the strategic steering perspective. But Rachel, I'm assuming that there's also a compliance side to this growth roadmap. So as nonprofit hit the same financial milestones, when does a formal audit or financial review stop being an option and start being a legal or a funder mandate?
That's a great question, and a lot of people don't know the answer to this. So there are first, there's each states each have specific laws on when you need an audit or a review. And this is typically triggered if your organization is registered as a charity in a state, they each have state requirements. So for instance, in Maryland, when you reach $750,000 in public support or contributions, excluding government grants, that's not public money. That's when you need an audit. Anywhere from 300 to 750 in Maryland is a review. And in Virginia, the rule is $1 million. And I'm going to put this, there's an interactive map that shows what each state's audit requirement is, audit and review requirement based on the locations that your charity is registered in. And I actually recommend this website for any nonprofit, even like not just the interactive map. The Council of Nonprofits basically has anything you need to know, but didn't know to ask. It's just a great, it's a great tool if you have any questions specifically. So that's when they're triggered by state regulations. There's also times where a donor will require audited financial statements, sometimes even during the application process. They want to make sure that someone has verified your books and that they're all in accordance with GAAP. Some will require it after they give you money, right? To see that you're cleaning it up and you're getting, an audit and someone has signed off on your financials. The third and the bigger deal is the single audit. We talked a little bit, it's like uniform guidance audit. And we talked a little bit about this in the government grants and the de minimis rate for these, but it's if your organization spends $1 million or more in government grants and federal grant funding, you're required to undergo a specialized kind of audit called a single audit. And this adds a lot of cost to your annual audit. It is probably almost double what a normal audit would be because of the requirements and the compliance issues. So if that's something that you think you are heading towards, it's probably a good idea to put that in the budget or at least reach out to see how much extra that type of audit will cost on top of your annual audit. And then the difference is just in layman's speak about a review and an audit. A review is much less in depth. It's really inquiry and analytical procedures. We look at the financials, we look at trends, we ask some questions about the organization, and only a minimal amount of assurance is provided in that. You still get the end product of the financial statements and footnotes, but there's no opinion. We were not expressing that these are in accordance with anything. We've just reviewed them and applied procedures. An audit is when we're really going through your financials. We're tying in all of your balance sheet accounts. We're verifying your bank balances. We're looking at internal controls. We're looking at your grant agreements to see if you're in compliance with those. So it's a much higher level of assurance. And we are actually forming an opinion that your financials are in accordance with generally accepted accounting principles. So again, that's a much higher level of compliance.
And that's exactly where our worlds collide. I hear executive directors complain frequently about how much they dislike the annual audit process. They might say it's a month-long root canal where they're digging through filing cabinets trying to find receipts or explaining to their audit team why QuickBooks doesn't match their Excel sheets. But here's our secret. An audit is only painful if your monthly bookkeeping is messy. At TCG, we operate on what we call audit ready every day philosophy. It means every month we're reconciling balance sheet accounts. We attach receipts and documents directly to QuickBooks transactions, and we document our allocation methodologies as we go. So when audit time rolls around, we're not starting from scratch. We simply hand Rachel's team an organized PPC package. PPC is prepared by client. So the trail is already laid out for them.
Mm-hmm. And so this is something to really emphasize here. Audits are not meant to be painful, as I said at the top of the hour here. If we have organized books and organized schedules, as Jonathan was just mentioning, if we're working with teams like TCG, the audit should only take a few weeks to get through testing. Obviously, it takes a little bit longer to put together the financials, but if we have your attention and everything is in order, it is certainly not a painful process. And we have some clients that could attest to that. So I promise you it can happen. So there are independent standards. So my audit firm cannot act as your bookkeeper. We have to be legally separate. So we're not allowed to clean up your books when we do the audit work. So, if we show up and the books are a complete disaster, we do have to pause the audit and wait for you to clean them up. Because, like I said, we can't be doing so much accounting services like we're doing your accounting for you. We are just looking at it to verify the balances. And that actually is when the fees start rising because we have to charge extra because you're not ready. But when we work with people like Jonathan and TCG, they're already closed and accurately on the accrual basis. So our testing is clean, the audit is faster, and the board gets their report on time or maybe earlier than they expected. And most importantly, the fees are manageable and as expected.
Exactly. It's the difference between building a stable foundation day by day or trying to patch a leaking ship in a storm.
That just gives me visuals as it's like thundering out here. We've had warnings of tornadoes. But I love the breakdown of how strategy and compliance actually work together to protect an organization's mission, which is really why the nonprofit exists, right? Is for the mission. So let's pull back and prepare to open the floor to your live questions. If you don't feel comfortable coming off mute, feel free to put them in chat. I have no problem reading them for you, but you're welcome to come off mute. And let's look at the absolute top takeaways from today's session.
Right. So first, don't look at your bank account to manage operations. A healthy checking balance is an operational illusion if it's packed with time capsule cash meant for next year. So you need to look at your reports as a connected ecosystem. Second, don't start at the bottom of your P&L. A paper surplus at the bottom can mask an unrestricted operating crisis at the top. You have to understand not just how much money you have, but what kind of money you have. And third is to use that budget versus actual as your early warning GPS. Don't wait until the movie is wrapped and released to realize you missed the plot. You check the script against the footage every month, hopefully by the 15th of the following month.
And from my auditors, with my auditor's hat on, my main takeaway is an audit is not something that you can cram for in a study session the night before. It's a system that you have to build day by day, making sure that you have accurate accounting on a monthly basis. So when you have an outsourced accounting team like TCG implementing clear allocation methodologies and keeping your balance sheet accounts reconciled every month, you aren't making my life easier. You're protecting your fiduciary responsibilities, keeping your board at ease, and ensuring that every dollar your donors trust with you is directly where it belongs at your mission.
Beautifully said. So I'm going to give everybody an opportunity to come off mute or type in their chat box. But who has a question for one of us? We do have a question that came from somebody who was unable to be here, but they have this great question. And Jonathan, it's definitely more for you, or question, Rachel, it's more for you, but Jonathan, you might have a good take on it too. So our board is terrified of financial reports. And when we show them the balance sheet, their eyes just glaze over. So if we only have 2 minutes to explain our balance sheet health in a board meeting, what should we focus on?
Thank you for that. So my recommendation would be to pull up that, gap liquidity footnote. Just show your cash, your current, your liquid financial assets, and then what is designated for future purposes or future time restrictions, and show them that line that shows what you have ready for general expenditure within 1 year. I think that gives a really clear indication of this is how much money you have for your operational runway. And it might not even take 2 minutes. It might take a minute to explain that. But I think that's the highlight. That's really what they're looking for.
And from our side, I think what we try to do to prevent the glaze over effect is provide a couple of clear visuals. So we'll show how you're doing budget versus actual, but also on the balance sheet side, what their real cash operating cushion is. And if we can do that in a summary statement with a couple of clear visuals and trends, it's easy to take away the important information quickly.
Okay, that's incredibly helpful. So this next question is from a board treasurer for a growing youth development organization, and he is asking, we approach a 1.2 million budget. Okay, so they're in that one to getting close to that 1.5 that you mentioned, Jonathan, and currently do their bookkeeping in-house on a cash basis. He's asking, do we really need to move to an accrual basis accounting, and how painful is that transition?
Well, I'll start. And this actually comes up. I see it. I see it in organizations that I'm working with. So it's essential. You have to transition, especially when you're getting to that threshold. The likelihood that you're going to have an audit is increased because most states will have the requirement for $1 million is a lot. So, and in that sense, the books have to be on accrual basis because that is the generally accepted accounting principle. So you really do need to move to accrual basis financial statements. We can't audit cash basis. And like I said, we can't redo your books for you. So again, we have to pause and have someone clean it up for us. So it is essential from our perspective.
And we've run into this as well. We had a client a couple of years ago that was in exactly this scenario and needed to transition to accrual basis. And it's really actually not as hard as it seems. Because of the revenue recognition rules, like you're already having to deal with things on a kind of modified accrual basis. So there's just a few procedural things we need to add into the workflow to convert things into an accrual basis and be producing correct accrual based statements on an ongoing basis.
Mm-hmm.
Okay, so that's the perfect transition to wrap up for today. We promised you at the start of this webinar that we would take the fear out of reading your financial statements. But understanding the reports is only step one. After building and maintaining these audit-ready strategic reports month after month, that is a massive operational lift. We understand that. So if you're an executive director who's losing sleep over an $18,000 discrepancy in QuickBooks on a Sunday night, or you're approaching those audit thresholds and realize your internal systems are messy and you don't have to drive the ship alone.
Exactly, Mackenzie. At Consonance Group, we believe that administrative excellence is a prerequisite for social impact. Your back office operations must be as resilient and forward-thinking as the mission you support. That's why we offer complete outsourced finance and HR departments specifically tailored for growing nonprofits. From running your daily bookkeeping and payroll to providing high-level fractional CFO strategy, we deliver the exact expertise you need when you need it for less than the cost of a single full-time senior hire. We want to give you back your operational peace of mind, a paperless back office, and the freedom to focus entirely on your mission.
And from Snyder Cohn's side, we want to help you navigate the compliance side of that growth. If you feel like you're approaching that state registration threshold, or you're winning additional federal funding or increased grants and contributions from elsewhere, or you're really just preparing for your first formal CPA assessment, we're here to ensure that your compliance guardrails are solid, and we're here to help as a consultant for anything, internal control related. So always willing to have a chat about that. And I promise we are not scary auditors at Snyder Cohn.
So we do have two immediate high value next steps for everyone tuning in today, and for those who signed up, and we'll get the recording as well. So I'm going to drop a link in the chat box right now for our 3 Essentials board dashboard template. This is the exact high visual plain English reporting template that Jonathan's team uses to keep his boards aligned and at ease. And then second, if you want to identify the gaps in your current financial setup, check your audit readiness, or explore how fractional support could be a right size for your finance department, I put the link in there to schedule a complimentary 20-minute consultation directly with Jonathan. And if you want to explore any compliance or audit items with Rachel, I'm going to drop Rachel's email address right in here right now. Oh, it cut off. Don't click on that link. That's not going to take you anywhere. It's going to take you to the wrong person. There we go. There's her right email, and you can schedule a time to discuss there. And then please do check your inboxes. I'm going to say tomorrow morning, but it could be late morning, so like 12 Eastern. We'll be sending out a copy of today's recording along with what I just shared in the chat box, as well as a cheat sheet for the top 3 questions to ask your finance team to help you kickstart off your next monthly meeting with confidence. And I want so greatly much to thank our incredible co-presenters, Jonathan and Rachel, and thank you to everyone for the tireless work you do in our communities every day. I hope everyone has a wonderful afternoon.
Thank you, everyone.
Thank you.